Welcome to The Explainer. Today, we're diving into a new 401k rule. It's one of those that's kind of flying under the radar, but it could totally shake up your retirement strategy. And this is especially true if you're over 50 and a high earner.
All right, let's just jump right in with a question for you. Do you make those 401k catch-up contributions to, give your savings an extra boost? It's a super popular strategy, especially for folks who are getting closer to that retirement finish line.
Well, if you answered yes to that, you are definitely going to want to stick around. There's a pretty big change tucked away in this massive retirement law, the Secure 2.0 Act. And believe me, it is about to change the rules of the game, but only for a very specific group of savers.
Okay, so let's get right to the heart of it. What is this new rule exactly? Well, in a nutshell, it's all about how those extra savings are taxed, and for some people, it's a complete flip.
So here's the bottom line. Starting in 2026, if you're in this specific group we're talking about, any and all catch-up contributions you make to your 401k have to be Roth contributions. And what does that mean? It means you're using after-tax money, not the pre-tax dollars you might be used to.
Right, so the big question is, who does this actually affect? Is this you? Well, the good news is the IRS has made it pretty simple. There's a clear two-part test to figure out if you're on the list.
First up, Part 1. This is super straightforward. It's all about age. This rule only applies to workers who are 50 or older. The same people who are eligible to make catch-up contributions in the first place. So if you're under 50, you can breathe easy. This specific rule doesn't apply to you.
Okay, on to Part 2. This one's all about your income. The rule kicks in if you earn more than $145,000 in the previous calendar year. And this is important. It's not just any income. We're talking specifically about W-2 wages from your current employer.
And here's a really key detail you got to remember. Since the rule starts in 2026, the IRS is going to be looking at your W-2 wages from 2025 to see if you cross that line. Oh, and also that $145,000 number, it's indexed to inflation, so don't be surprised if that figure creeps up over time. So it's actually pretty easy to figure this out for yourself. Just ask two simple questions. 1. Are you age 50 or older? 2. Was your income from last year over that $145,000 mark? If you're nodding your head yes to both, well, then this new Roth requirement is aimed right at you.
Now, to really get why this change is such a big deal, we need to do a super quick refresher on the difference between Roth and pre-tax contributions. Really, it all just boils down to one simple question. Do you want to pay taxes now or pay them later?
Okay, so what's a Roth contribution? At its core, it's actually beautifully simple. You're putting money into your retirement account after you've already paid income tax on it. And here's the magic part. Once that money is in the account, it grows 100% tax-free. And when you go to pull it out in retirement, yep, still completely tax-free.
This really lays out the trade-off perfectly, doesn't it? With a traditional pre-tax contribution, you get a nice tax break right now. It lowers your taxable income for the year. But you've got to pay taxes on all of it when you withdraw it down the road. Roth is the complete opposite. You pay the tax today, and in exchange, your future self gets to enjoy all that money plus all of its growth totally tax-free. It's a classic now versus later scenario.
Okay, so we've got the concept down. Now let's talk about what this actually means for you, the real-world impact. Because forcing high earners down this Roth path for their catch-up money, well, it's got some potential upsides, but also some pretty big risks.
Let's start with the good stuff. For you, the saver, the biggest benefit here is creating this bucket of tax-free income for retirement. And let me tell you, that is an incredibly powerful tool to have. Think about it. If you expect to be in a higher tax bracket when you retire, then paying the taxes now while your rate is lower could be an absolutely brilliant move. You're basically locking in today's tax rate for good.
But let's be real. This rule isn't just about helping you with your tax planning. Nope. There's another major player here that benefits, the federal government. See, by forcing these contributions to be Roth, the government gets its tax money right now, today. They don't have to wait decades for you to retire and start taking withdrawals. For them, it's a huge immediate boost in tax revenue.
And this brings us to what is, honestly, the single biggest risk and probably the most urgent takeaway from this whole thing. Let's play this out. What happens if you're a high earner, you're over 50, but your employer's 401k plan doesn't even have a Roth option? Well, under this new rule, the answer is shocking. You might not be able to make any catch-up contributions. At all. Zero.
Now, this change didn't just pop up overnight. It's actually been in the works for a little while. The Secure 2.0 Act, where this rule comes from, was passed way back in 2022. And believe it or not, this was all supposed to kick off in 2024. But the IRS ended up hitting the pause button, delaying it for 2 years. This gives employers and plan administrators some much-needed breathing room to get ready for the new start date in 2026.
And we're not talking about small change here. The amounts are pretty significant. For 2025, if you're 50 or older, you can put in an extra $7,500. And get this, for those between 60 and 63, that amount jumps to a whopping $11,250. So you can see why losing the ability to save that extra cash could be a huge setback for someone's retirement plan.
All right, that was a lot of detail, I know. So what are the absolute key things you need to remember from all this? Let's boil it all down to the most important takeaways. Okay, let's wrap this up in a neat little bow. Here's what you need to know. The rule. It's for high earners over 50 forcing their 401k catch-ups into a Roth. The start date, 2026. The big risk? You could lose your ability to make those catch-up contributions entirely if your plan doesn't have a Roth option. And that leads to the most important thing, your action item. Call up your HR department or plan administrator and ask one simple question. Do we offer a Roth 401k option?
So we'll leave you with this to think about. This change, it's not just about following a new rule. It's really about strategy. It kind of forces you to think differently about tax diversification in your retirement plan. You know, it's both a new challenge and a fantastic opportunity to build up that pot of tax-free money for your future self. Thanks for joining us.